All right, so there was a question in the chat room today on, from Matt. A couple things. Is a frog quality number of 5 or 4 an even better frog candidate than 3, or would you consider it more of a baseline filter? It's really one of the conditions. It's not even a filter. So what we want to talk about with frog candidates is that we're looking for something that's poised to make a large move. A large move tomorrow, relative to the size of the frog box. Now, when I say the frog box, we're talking about in Frog 1.0, the frog box itself, which is the standard deviation of the 30-day range. It's sort of a measure of volatility. What we want is a large intraday move that would have a number of frog boxes. And if we saw something like this, 1, 2, 3, 4, 5, and we had let price move off the low, and then we got an SSC or something right here, and then we could get 4 frog boxes compared to a 1 frog box of risk. In Frog version 1.0, we were using a full frog box as the signal, the first non-noise signal. We're looking for a non-noise signal. And our idea was that by using the frog box as the standard definition of a non-noise signal, that we would have seen price go to a low of the day and then reverse up. And then when it had moved a non-noise signal, then we had a reason to believe that price was going to move up. And then what we want to see is something like a range stat kind of a day, where you get multiples of frog boxes moving away from the low of the day. In Frog 2.0 and in sniper trading in general, what we have learned over the years is that we don't have to wait for the 100% certainty that this was a signal and not noise. What we've learned is that you can actually tolerate a move of about 0.3 or 0.4 of a frog box off the bottom, and then you can get an entry sooner. And now this little piece in here, the remainder of the frog box, instead of waiting for the 100% certainty, by that time you might actually be able to take your risk and move that above a frog box or something like that, and now you've actually locked in a no-lose plus dinner for 2 and taken your risk out by the time that the regular frog was just beginning to enter. Now, the beauty of this is that we know that Frog 1.0 is a positive expectancy system. So if you can reduce your risk box, then you're going to improve your R multiples. You're going to get in sooner. You'll get to no lose plus dinner for 2 sooner, and you can get larger R multiples. This insight was the beginning of the idea of the minimum manageable risk box, and why we want to compress that to the point where we're not taking larger than a 1 MMRB loss against us. That's where the R10 factor comes in, because now we're taking the range stat and we're dividing that into 10 equal slices. And then instead of a full frog box, which is normally about 3 of those, we're getting an entry down here at about 1/3 of a frog box, and we're getting a 2-to-1 reward to risk just to the top of the frog box. So if you can manage that idea, what you're seeing is that you are reducing the you're increasing the reward to risk ratio. Now, I say all that simply to say that what we want in frog trading or intraday trading or sniper trading or RLCO trading intraday is candidates that are poised to make a large move. One of the ways that we first determined that in Frog 1.0 was a large frog quality number, because what that told you was that the average range, when divided into frog box increments, when it was better than 3 to 1, then a frog box move would give you a 2 to 1 reward to risk on a simple move to the average range. And if it moved to a range stat, you get an extra +1 frog box. So in our reasoning, if you had a frog quality number greater than 3, then you were sufficiently compressed so that an average move would give you a favorable trade-off. So that's one of the working definitions of a relatively large move tomorrow compared to the risk you want to take. But the real question that Matt's asking is, how do I find the best frog candidates? And I want to say, don't key in on the frog quality number as the thing that is differentiating. What we want are candidates that are poised to make a large move, and we know what those are. In the frog and day trading home study course, you'll see this chart and a little video on this, and I want to update it a little bit right now. So we said that all of these things give you a good frog candidate. Candidates to be good frog trades the next day. In other words, it's simply potential to make a larger than normal intraday move in either direction. That's actually the original idea behind the compound critical state. In which we have a critical state defined as the potential to make a larger than normal move in either direction in a shorter period of time. And the idea of the compound critical state is we can start stacking these things up, that if we now look at a 10-day look back, a 30-day look back, and a 150-day look back in the sniper, if these are all in critical states in each one of those lookbacks, we now have 3 different demographics that are all contriving and conspiring to make this a large potential move. So all of the sniper patterns, all of them, give you a compound critical state. And so I'm going to add any sniper setup is going to be a great frog candidate, which is just shorthand for saying these things are poised to make large, surprising moves. Not surprising to us, but surprising to all of the people in the various lookbacks that maybe don't have our tactical sense of what's going on in the market. So I will tell you what makes a good frog candidate: any sniper pattern, any frog quality number better than 3, because by definition, it is compressed to a relatively quiet state where an average move is going to give you a large multiple. Any symbol that has a high signal-to-noise ratio, in other words, greater than 0.5. Well, what do I mean by that? What I mean is that if you go back the last 30 days and you take a look at all of the daily candles, the real body of the candle is signal, and the tails are noise. Why? Because they couldn't hold that price. It opened here and closed here after visiting the highs and the lows. So the real signal of the day is from the open to the close. That's how strong the signal was. And then the tails represent noise. So if you take the signal, which is the close minus the open, and then divide that by the range, which is from the high to the low, you get a number between 0 and 1. and it represents the percent of the daily price action that was signal rather than noise. You'll see that reflected in the daily report for our tactical symbol set and all over the TC2000 bundle, by the way, for thousands of symbols. What we want is something that has a high signal to noise ratio, all other things being equal, because that means it's making large intraday directional moves. So a price candle that looks like this, that opened at the low of the day and that did nothing but go straight up and closed at the high of the day, that would be 100% signal. It was all directional. There was no noise whatsoever. So if over the last 30 days it always did that, it would have a signal to noise ratio of 1.0. You can't get any better than that. Well, that's what we want, is we want things that have very directional behavior intraday, so that when we take our small risk box, that we have some expectation that it could have a large directional move, and that pays us off. So we would like to see, all other things being equal, a high signal to noise ratio. We would also like to see swing trades that signal at the start. Because why? Well, because the swing trade signal fires like on a 5-day down. You have 5 lower closes. And now suddenly this thing is poised, if it breaks out of yesterday's range, to make a strong directional move for the next, 3 to 5 days. When you see that kind of a swing signal, it means that if it starts moving up, guys are going to start buying this thing, and you're going to get a large move, and it'll probably be directional. So a swing trade signal that just fires tells you that you can have a directional bias with a larger than normal move in order to fix the price anomaly that generated the swing trade in the first place. 5DD says the sell-off was probably overdone, and it's going to try to run back to what was previously fair value. So you get larger directional moves. Those make great frog trades, not because the frog quality number is better, but just that it's poised to make a larger than normal move. An extreme trade location on the NDX10, and this was a precursor of our critical states for the sniper, was that if you look at the 10-day range, which is a perfect time frame for understanding swing trades, if you had something in the top 20%, so it's overbought, there's a good chance that the next day is a breakout or a reversion back to the mean. Either one of those is a move from a critical state based on location, and you get a large directional move. Same thing if it's oversold on that NDX10, you get either a large recovery or a collapsing dragon. So an extreme location on the NDX10 is an indication that tomorrow might be a good day. That's why you see me highlighting those in the daily report. I would now add to that a 30 and a 150, and now suddenly what do you have? Oh, you have the essential elements of a Godzilla. That's the very best definition of something poised to make a massive move. Well, if yesterday closed in a doji, that is sort of a range, and that I will combine that with max pain range compression. A doji simply says that the breakout from this compressed state could be a large bounce up or a collapse out of this period of tension. If you add to that the previous moves was a large directional move down, so maximum pain, now suddenly the combination of maximum pain and a little doji gives you an enormous change in psychology from fear and loathing of the big sell-off into a tightly compressed tug of war. That's such a huge difference in psychology that the move that comes out of the doji could be enormous to the upside, or it could be large to the downside. So max pain range compression and a doji yesterday both lead you to the possibility of larger than normal moves. A just completed significant directional move. So if you see something like a leg 1 move up that terminates in a doji, we wouldn't be surprised to see leg 2 or a reversion to the mean. Preferably a doji, but a large significant move means it's in play, and now maybe the other side of the trade comes in, or maybe some additional buyers come in. So a larger than normal significant move. In other words, how about a Z5 score or a Z1 score that are extraordinary? Both of those are a good hypothesis for a continuation move. And then finally, if the market itself or the sector of the targets you're looking at, or if you're looking to trade the sector, if markets and sectors are poised in any of those, you're also going to have a broader effect for entire groups of stocks and ETFs and symbols. So all of these taken together, and more is better, all create candidates for good frog trades. So the frog quality number itself is simply one of those things. But what if you didn't have a good frog quality number? Well, if yesterday was a large move, or you've had a series of a couple really good moves in a row, it's very hard to get a large frog quality number because the increased range expands the standard deviation, and you'll never get frog quality numbers better than 3. But you could have all of these other things in play, and they would be great candidates for a frog trade. So I don't want you to think of the frog quality number as a screen or a filter. It's really just one more indicator that gives you some idea of the size of the average range compared to the volatility compression in the frog box. It's just one factor among many to find things that are poised to make larger than normal moves. So I wanted to answer that question because it is foundational to the way we're trading. And I want you to see that in the evolution of our ideas that Frog 1.0, in much the same way that RLCO 1.0 gave us a great start on our tactical frameworks, those things have been updated and improved on by second generation RLCO, things like the named patterns of the supported spring crossing and the owl and the Z3P and all that. This builds on the sound foundations of the RLCO, and that our sniper trading is an improvement over the frog because it reduces the size of the risk box, adds some additional patterns, and allows us to incorporate some of the other features of our tactical framework to give us more insight. Frog 1.0 was a minimum rule set that didn't include any discussion of support and resistance from the previous day. It was an effort to try to be information sparse and simply move off of price bars and a statistical definition of the difference between signal and noise. In other words, to get out of your bias and in your interpretation, to simplify the rule set. And it's a positive expectancy system. It's just that these are better, especially the sniper. So I wanted to answer that for Matt because he asked me a good question and he's just getting started. All right, let's take a look at back to our regularly scheduled program here. Hopefully you found that helpful. All right.